Welcome to the Building Web3 Podcast. I have two of my good friends. We got Ben, he's the co-founder of SOLSTICE Labs. We got Tim, CEO of Deus Ex. So I'm going to let him pronounce that because for some reason that word evades my pronunciation skills. So Tim, give me your complete title here.
Yeah, no worries. It's you're not the only one. Don't worry. So yeah, I'm CEO of Deus Ex Capital, and we have a lot going on actually across that portfolio, which I'll get into a bit later. But I'm also chairman alongside Ben of SOLSTICE Labs too.
Absolutely, and just to dive into SOLSTICE Labs immediately, talk to us a little bit about some of the starting of SOLSTICE Labs and what is its mission ultimately.
Yeah, well, look, let me start there, and then I think Ben will do a lot of the talking, given his role in leading the project. But I can kind of talk a little bit about why we are doing it at all. And Deus Ex Capital, we've got about $1 billion of across multiple areas. We have a VC portfolio. We allocate to funds. We build our own enterprises, of which this is one of them. And we also have a lot of operating businesses actually that that ultimately generated the wealth that we manage, but are also still functioning out there, and they're in the foreign exchange trading and capital market space and gaming. So we've got like a large number of assets which are very focused on this intersection of crypto and institutional, and that's really our core thesis at Deus Ex. It's around the belief that convergence is inevitable, that institutional money is going to want to get access to the tool set that we've been building for the last decade plus in DeFi and in crypto. And we're trying to inhabit that middle ground and really, be that bridge. We understand traditional finance really, really well because many of us have come from that space. But we also understand DeFi and crypto very well because we've been in that space for a decade. And it's that combination that we think it really drives us to allocate capital into building things. So if you look at our footprint, we have on our enterprise side, we have Alpha Lab 40, which is run by my colleague, Deus Ex CIO, Stuart Connolly. And that's running a fairly significant amount of capital. And that's a captive prop unit. And we're trading the basis. We're trading the things that ultimately we're going to need to be able to do in order to drive this SOLSTICE Labs initiative. We need to be able to trade. We need to be able to do it well, and that's exactly what we do in Alpha Lab 40. And then Core Prime, which I lead, which is our institutional lending unit. You really got to get your primitives together, and one of the primitives is being able to extend leverage and extend credit in this space. And again, from a very institutional perspective, we're building that piece. And then we've also got soon to be renamed, but we currently own Haven, which is a payments business, and that will be renamed actually next month. And that's another primitive, right? Being able to do the on-ramp, off-ramp. And when we looked at the kind of the space and where we think things are going over the next couple of years, we realized that there was room for us to have a very dedicated DeFi unit, but we're calling it an institutional DeFi unit. And the reason that we're doing that is because we've got all those pieces. Now we can go and build protocols and products that are designed very explicitly to fit with those other things, i.e. to fit and be appealing to an institutional investor. And that's because ultimately, though it's great to see this community building and growing, what we don't want to see is just recycling of the same capital in the community. If we just keep restaking and staking and restaking, we're going to reach a point where we're not going to be able to grow. We need to be the ones that liberates traditional risk capital, traditional investments, investor capital, and allows it to come into the space. Then we've got a bigger space. Then we've got more liquidity. We've got more ability to grow. And so that, in a nutshell, Jax, is why we created this, because we think we've got all the pieces. We know how to build and deploy technology. We know how to do the trading. We know the regulatory aspect. We know the institutional environment. Let's bring them all together and actually go and build these products that will stand up to that institutional mindset and that institutional scrutiny. And so far, feeling very good about it, because let's face it, we denounced this back in September when Ben and I were at Token 2049, and I'm not entirely sure we could have hoped for much better. A better backdrop since then to kind of support what we're doing. It's actually across the board. Like, we're all feeling good in crypto at the moment because of what's going on, but this really, to put a fine point on it, to see at the tail end of last week the kind of institutional interest in the MicroStrategy convertible tells you now that the institutional money is ready to take this side of the market very, very seriously. And the ETF was what we needed to kind of unblock it. But our anticipation is that will only continue, and that's exactly why we're setting up Solstice Labs to satisfy that demand. So that's the genesis story, Jax.
Yeah, and I kind of want to double into that, because a common critique you'll hear, not really on our side of the internet, but on another side of the internet, they'll say that blockchain is often a solution looking for a problem. But you've mentioned a few areas of product market fit where institutions will actually come in. So obviously we've seen the Stripe acquisition of Bridge. What are some of the areas you personally, and I'll let Ben jump in on this as well, think that like we've really actually achieved product market fit, and like the BlackRocks of the world will be adopting what we've been doing in DeFi?
Well, I'll have a quick go and then I'll pass to you, Ben. So what's interesting, if you look over the last decade, and you take that journey from where institutions first start to get their head around this whole space, and they make a bunch of assumptions about what's going to happen and how long it's going to take, and those assumptions turn out to be wrong. Things are going to take longer and harder. And the primary reason for that is actually the mindset that exists in traditional finance. I think that's actually what we're fighting against here, because unlike 10 years ago, where we probably still had to prove the technology was scalable and resilient at a global scale. Now, I don't think anybody really has a leg to stand on anymore to say that the technology isn't resilient and can't scale. Like it can, and it has, and it's not hard to make that case. So then you get the whole, but it's for gunslingers and drug pushers, and it's just sort of the Wild West out there. And I think that's also been debunked. And then you've got all the sort of the eco arguments with Bitcoin, which have now been quashed as well. And you slowly but surely get to the point where there's really, and then you've got, regulation. And I would argue that everywhere you look, in every jurisdiction in the planet, now the trajectory to getting harmonized legislation, even if we're not entirely sure when and how it happens, but you wouldn't bet against that happening now. You're pretty certain that everywhere is going to get there. So what's left? And what's left is actually, it's about the mindset. It's about the C-suites of institutional finance starting to, maybe stop saying things like the one you just said, Jax, which I think you're absolutely right. You still get these things leveled like blockchains, is a problem. It's a solution looking for a problem, and it's kind of like, okay, how long have you got, and are you willing to listen to hear that that's really not the question? If that's the question you're asking, and you're the CEO of a big global institutional asset manager, I'm afraid you're way, 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 way behind BlackRock, whose CEO, the biggest asset manager, is on record on a regular basis discussing how this is an important part of the future of finance, and they've put their money and where their mouths are for all of this. And I think that's the interesting part. It's actually the hardest part, right? It's everything else we've kind of got sorted. Now we need to get people to engage in a commercial conversation about how this is going to change the future of delivery of financial services. And there's every incentive from the traditional 20th century model to be a Luddite and to be defensive and to not want things not to change. And I think that's actually the thing that we in crypto and DeFi, we're not shackled by that. We're all looking at the rising tide lifts all ships. We all believe that this has to be done collaboratively. Networks is how we win. It's how we get the access, and we democratize this. And you'll see us use the term democratize a lot because we think it's quite important, and I think everybody in the space would agree. Now we're into tricky territory because we're debating business models, and there isn't the pithy well, this is bad for the, the bad for the environment, like, or and it's just criminals that use it. Like, I don't know. You can't really go there anymore. So I think it's fascinating. By the way, last thing before I pass to Ben, when I came into this space, the thing that got me most excited was being able to use blockchain to remove the need for reconciliation in financial services, because we spend so much time making sure that what you think happens is what I think happened, and that's actually a huge and more than people think, more than people realize, a huge burden of what we do is just trying to make sure that happens. And that's the easiest argument of all. Like, they've just used these tools to not have to check. Why wouldn't that be one of the most sort of efficient plays in financial services? It's not really that hard. But Ben.
Absolutely. And to that point, Tim, I think one of the major narratives right now is the commercialization aspect. There are so many large-scale opportunities and institutions that are looking at DeFi and crypto with absolutely no idea how to participate. A lot of the institutional applications, as Tim alluded to, over the course of the last 10 years or so, has been figuring out where that technology fits within the ecosystem, rather than how does my institutional capital participate in this new world. And so that right there is the crux of where SOLSTICE Labs really enters the market. And institutional DeFi is a term we've seen thrown around in everything from consulting reports to talks, much as on stages. And there's very few players in the space that can translate that into tangible items, because of the fact that it takes an institutional player like, for example, the Deus Ex ecosystem and launching SOLSTICE Labs to have that basis and understanding of what institutions will feel comfortable with in deploying that capital for. So very explicitly, SOLSTICE Labs is very excited about this fact explicitly, because we're able to say, here are institutional rails and two key flagship businesses that we're going to launch into the market that allow for institutional capital to participate in a safe, regulated, and secure manner that allows for them to participate in the yields and the commercialization opportunities in DeFi, while the DeFi communities are able to participate with the increased liquidity from the institutional world. A lot of people in the DeFi world built up these almost walls around the fact that we don't want institutional participation. We want to do this ourselves. This is outside the scope of the traditional world that, we came from. And at a certain point, those walls start to break down on both sides. And that way, in that democratized way, everybody is on the same playing field, whether you're a large scale capital provider or your everyday retail investor. So that's one of the things we're most excited about in the SOLSTICE Labs piece.
Yeah, and let's go deeper into SOLSTICE Labs. So one of the things we used to do as an exercise at BlackRock is the life of a transaction. So talk to us a little bit about like the features and kind of the life cycle of where you guys see fitting in.
Absolutely. So to take a step back, the two businesses that I alluded to earlier, the first and foremost is one that we've been developing and thinking about since May of this year. The stablecoin ecosystem has obviously blown up to, we're at roughly 167 billion market cap at the moment and growing. Stablecoins have been one of the primary drivers of capital introduction across DeFi. And the main reasons why people are coming into stablecoins is for three major reasons. The first is passive income opportunities across a lot of these DeFi yield pieces. The second is hedging against market volatility while still being able to participate in the ecosystem. And the third is reduced transaction fees for just translating capital across multiple counterparties at a stable basis, right? So you have this huge influx of stablecoin opportunities. And we've seen two sides of the spectrum evolve for incentivizing players to utilize stablecoins. We've seen companies launch RWA, real-world asset products, the tokenized short-term treasuries primarily, which dominate the market on the RWA side. A lot of the times you're looking at 3 to 5% yield. They're highly regulated opportunities to invest in, but the yields, compared to what we know in DeFi, is not so attractive. So on the other side of the spectrum, you've had these players such as Athena and Midas and others that have gotten very creative in tokenizing trades in the market, like the basis trade, for example. Real trading dynamics and market opportunities that exist that traditionally only are engaged in by institutional traders or prop shops or companies that are more familiarized with this. It allows for all investors to participate in that yield by passing that yield back for a fee while using the stablecoin as the capital introduction method. And a lot of credit to those who have broken the ice in that industry and gone through. The depth of balance that we see in our minds is that on one side of the spectrum, it's high yield, but less transparency, less maybe regulatory certainty, while the other side is high regulatory certainty with not as much yield. And so that was the key motivation for us to say, wait a minute, we can do this right. We can do this in a way that is highly transparent, regulated, has a back track record with high liquidity to do these trades onto the market and get this accessible to everybody. And that's where the idea for Solstice Protocol was birthed. And that's what we're excited to announce that we're going to be launching in Q2 of 2025. It will be a Solana-based synthetic stablecoin out into the market. And we want to champion the narrative of getting Solana, its true L1 stablecoin, out into all applications. So this will be issued on Solana. This will be available to utilize across applications such as payment, trading capital, risk capital, a wide suite of applications we expect to partner with at launch. And most excitingly, all of those participants also will have the opportunity to stake it or lock it up into our yield-bearing protocol that will directly participate in the basis trade yields, which is at the moment, this past month, has been upwards of 25%. It's a delta neutral trade. It's something we can get out to the market at scale, and something we've been doing internally with the trading partner Alpha Lab 40, who we're excited to partner with, run by Stuart Connolly from the DSX side as well. We're going to be able to get those yields to investors on the institutional side and the retail side on a large scale basis, something we've been doing at 9-figure scales for, like I said, 20 plus months here. And that's part of that overall mission of introducing full breadth of capital and institutional and retail into this product. And the last thing I'll say on this, on the protocol side, is that one of the things we aim to solve on day one is there's a closed loop paradigm that always happens that we've seen time and time again with launched stablecoins. And what I mean by that is that invest in our stablecoin and you have one option for yield and that's it. The whole concept of stablecoin is to bring that institutional rail of capital into this new ecosystem. And right off the bat, you need additional applications, you need additional incentive programs. And at the end of the day, what's the value of my capital efficiency by going into a stablecoin? That immediately we want to bolster for all holders by saying you can use it for payments across several of our portfolio companies at the DSX level. You can utilize the stablecoin there. You can utilize it across CAX and DEX exchange optionalities. You can use it across application developments. And we're going to launch those suite of applications at launch. So as what is Solstice Labs as a business model, the Solstice Protocol is business number one. And number two, we're excited to announce in the next couple of weeks in the news an acquisition of a fairly large staking operation that also runs MPC and RPC services for institutional clients out of Switzerland. And we will be launching that under the umbrella of Solstice Labs, paired up with the initial capital investment and the partnership with DSX. So we're excited to have Solstice Labs pursue these two businesses of the Solstice Protocol release and institutional staking services into market. As we said, those two key rails for what is institutional DeFi. This is what that looks like.
Absolutely. And I want to go a little deeper into the synthetic stablecoins, because I think most people will be familiar with the idea of, okay, there's some kind of real world asset, either dollars locked up in a bank account or some kind of US treasury. And of course, like they're getting some kind of yield off that, no matter how small it is. Now let's go into this idea of there being essentially, what do you call it, a delta neutral trade, where, so talk to listeners that might be unfamiliar with Athena or Hermetic and this idea of, using a trade in order to like return yield back to holders of the stablecoin.
Absolutely. So at a high level, the synthetic stablecoin functionality is very similar to a traditional stablecoin, with the primary difference being the capital that is locked up for the synthetic stablecoin is in the form of crypto as opposed to fiat dollars or fiat currencies itself. So for example, users would come on and stake or lock up their USDC or USDT, or in addition to Sol and other major cryptocurrencies, into a collateral wallet. And each of the coins that are minted will be one-to-one backed and fully collateralized into the market. Now, on the back end, in that collateral holding, all of the holdings itself, if they're stable coins, and even if they fluctuate, or if they're Sol delta positive positions, they will all be hedged out entirely. So the collateral holdings will be fully one-to-one backed with each of the minted stable coins in the market. And this is something we expect to have full transparency of collateral holdings, full transparency into the market of where those holdings sit, the levels in which they're at, as part of the trust factor that is necessary to build that client stickiness. And as far as the trading dynamics go itself, what allows for in the market is that we were going to be partnering with a company, Alpha Lab 40, as I mentioned, that has been active in trading things like the basis trade and funding rates out into the marketplace, both on major liquid tokens and illiquid tokens, to capture that yield between spot and forwards on all of these major currencies. And this is a yield that persists in a lot of different markets. We've seen it fluctuate all the way down to close to zero, all the way upwards of 50+% even in the last year alone. Averaged out for, we'll call it the last year, floating around the 15 to 20% range. What users will be able to do is with that minted token that they receive, that stable token, they can lock that token up for, we'll call it 7 days or plus. Some protocols do it in different varying notions. Some have roll opportunities, etc. You essentially lock that stable coin up and you receive a staked version of that token in return. And that staked token is what the yield and rewards are generated through. And that yield from the trading operations are passed back at a fee in the form of the staked version of the token. And then at any given point, that staked version of the token is 1-to-1 with the base token. You can swap it back. And from there, you have full redemption opportunity to go back into your original cryptos at any moment as well. So you've got to create this fluid, liquid opportunity to participate in yields while still being a participant in the overall crypto ecosystem.
Yeah, I'm curious about what you guys think about the stablecoin market in general, because I think it's, of the things that crypto has produced, it probably has one of the biggest product market fits. And we've seen that with the Stripe acquisition. It's been my experience living outside the US in Medellin, Colombia, that like a lot of stablecoins are kind of winner take most, where most transactions that I know here in crypto are in USDT. Do you guys think that with this like proliferation of stablecoins, we've seen PayPal put out one, do we think that like most of these big like payment rail providers, or like yourself included, will produce their own stablecoin? Will we see like a BlackRock stablecoin, or do we think it's kind of like people that are relatively first to market will take a majority of the market share? I'm curious what you guys think about that.
Yeah, I'll start and then maybe pass to Tim as well. I think from the Solstice perspective, look, there's a few kind of competitive advantages that we definitely see, but one of the major items is that we all know the Solana community very well. We've been participants in the Solana community from very early on. It's a strong, tight-knit community, and Solana users love using Solana applications, and Solana users love using Solana itself. And so what is missing, we saw, in the last couple of years, we saw UXD protocol as a native yield-bearing stablecoin on Solana that was fully decentralized launch into market. Very supportive of the project. Unfortunately, there was a bit of a depeg and the project spun down over the last few months. But Solana right now is ripe for a stablecoin solution that is native to Solana. And so that in itself we see as a big opportunity. But as far as the overall stablecoin ecosystem goes, look, there are pockets where there are winner-take-all from major KEX liquidities that USDT definitely has a dominant nature for. But when it comes to individual applications, incentives, and yield-bearing dynamics with those stablecoins, those types of, all I see as stablecoins are capital introduction methods, right? This is not some winner-takes-all token. It's never been a winner-take-all market in crypto across the board. We've never seen that real dynamic persist, only in the early days. And then we've seen the decentralization of even the capital allocation. In the same breath, stablecoins, we expect that dynamic to persist. So in applications like Solstice, we see a direct competitive value for somebody to say, okay, well, if it's just as collateralized, the trust factor is there, the liquidity is high, and I'm able to get all these incentives. And if you're a Solana, maxi, you can say this is a Solana-based application. Then you're going to go in and say Solstice Protocols token is the one that I'm going to go with for my capital introduction. Bottom line is that the overall ecosystem should join together to create stickiness of capital into DeFi across the world. And so that's going to take a number of applications and a number of stablecoin applications specifically to do that. So without that, it's more or less the same market that we have today. So with no growth. So maybe I'll pass it to Tim for some additional comments.
The interesting dichotomy that we all live and breathe every single day in this space is, on the one hand, we can and should feel really proud and excited about where we've gotten to over the last few years. We're starting to cross over in very real terms into grown up institutional finance, and again, that convergence is what we believe in, and it's our entire thesis for a lot of what we do. The flip side, though, is we are still, even at a 3 trillion market cap aggregate, we're still, relatively speaking, a drop in the ocean compared to a lot of other asset classes. And we're really, when it comes to capital flows, and we're a big FX player, and you look at the volumes in FX, it's mind-boggling how big that is. It's trillions a day. It's the entire market cap being turned over 2 to 3 times a day of crypto. And I think it's hard sometimes for us in crypto to really remember that there's this we're at the tip of the iceberg. And so back to the stablecoin question, I think because of that fact, because in order for us to get to the next phase, we're going to want to see billions and billions of net fresh new institutional capital come in. Like when that comes in, the demand for the primitives like stablecoins is going to go up now, but then the onus will then be on those stablecoins to demonstrate certain characteristics which inevitably need to happen in order for that sort of broader institutional adoption. And that's where USDT could come a cropper for obvious reasons. And then, you know, what about USDC? Is that really the answer as well? I actually think this has a long way to go. That where we land on the stablecoin story, I think still has a long way to play out. And I would be really surprised if the current incumbents just naturally end up being. I think they'll be important just by the nature of the extent to which they're being used. But I don't know that it's so obvious that they will win and have outsized sort of economics in the long run. I think we might be surprised over the next few years about some of the players that will come out. And when you start, you know, money talks and the velocity of capital talks, and with the best will in the world, even the entirety of the crypto space, if we all went in the same direction, we can be dwarfed by the institutional capital flow. So I actually think that's why we're interested in getting involved in this space, because it's very far from clear where we land, which I think is opportunity.
Absolutely opportunity. So I want to go back into Solstice itself. So it seemed like there was a staking platform, there's a stable coin, and there's a protocol as well. Could you kind of just delineate those three things? And if they're both together, let me know that as well.
Absolutely. So the stablecoin itself will be the main launch in the new year at Q2. That will launch directly with Solstice protocol. And so to delineate the two, the stablecoin itself will have direct usage and application to the protocol should users that hold that stablecoin want to generate yield on that stablecoin. A big narrative here is capital efficiency. So in our minds, how do we introduce and graduate the next level of both Solana institutional participation and graduate that meme coin narrative as something as only a subset of the overall ecosystem? You know, Solana itself has been so attractive for so many reasons over the last few months, specifically from record capital inflows to record fees surpassing Ethereum and daily fees, in the last in a 24-hour period hitting over 11 million, while Ethereum's only around 6.3. These have been massive numbers that have been something that the Solana ecosystem has been waiting on. And it's been exciting, but a lot of that narrative is still driven by some of the more degen-y activities. So in our minds, how do we create that stickiness? How do we create that incentive structure for users to enter the Solana ecosystem and stay there, as well as, create bridges and swaps to participate cross-chain as well, not to be lost. And so day one is that Solstice stablecoin, which allows users to put capital in, both institutional grade capital at high levels, as well as, retail users in participating via DEX exchanges, grasp that stablecoin, lock that stablecoin up with the protocol for yield if they'd like to do so, but then also go ahead and use that for payments, for trading capital, risk capital, and across multiple applications in the Solana piece. That is what day one looks like, and that's what embodies the overall Solstice protocol and then stablecoin. Now, the staking business in its side, at first, we're going to be launching this under a separate entity, Solstice Staking AG, and a Swiss-based entity that will be running this primarily on the institutional side. And what's exciting about this is there's lots of institutional grade staking opportunities and yields that we would love to open up and democratize to both institutions and retail to participate in. The staking business in which we're going to be running will be fairly sizable across chains, not just on Solana, across chains of multi-coins. We'd like to bring those over to bolster yields, to offer additional incentives and allow for users to participate and the network validation fees that, staking operations get rewarded with. So very simply, there's just a delineation of the staking business that will be a separate entity that we'll look to open up in the later portion of next year. But the Solstice protocol will be the focus point for the Q2 launch.
Absolutely. That makes a lot of sense to me. And I have one final question more so about the Solana ecosystem, because you guys have chosen to build there. When I first started the podcast, it was mostly Ethereum based, and we talked to some people in the air, but it was mostly Ethereum. I'm starting to become more bullish on the Solana ecosystem, but I'm curious from the builder and capital provider perspective, what really attracted you guys to the Solana ecosystem?
Yeah, I can start with maybe Tim as a note as well. The main thing is, I think, from when we think about institutional readiness, the technology stack on Solana is incredible as far as TPS structures go, security, uptime, the overall availability for Solana to perform at high levels. We view it as something that could be trusted in for an application like Solstice Protocol. This is backed up by, over the last 3 months alone, we've seen over 800 million in net inflows directly to the Solana ecosystem, which has outpaced the other top 15 coins combined, right? The Solana's availability and the institutional capital that's coming into it is starting to recognize that tech stack. And the ability for Solana to scale with hardware improvements is one of the key technical differentiators that we see as a benefit of looking at Solana now versus in 5 years. As GPUs, as CPUs, as hardware components really scale up, Solana will scale up linearly with those hardware advancements. It won't take in a huge overhaul of software components that's going to need to bring it up to speed like some of the other chains that we see. And we also don't see this kind of overarching L2 environment choking the industry or choking the liquidity out, as we've seen, for example, evolve in the Ethereum community, which is definitely a problem to solve. Not speaking bad on the Ethereum community, I'm a definite supporter. It's just the fact that when you have this huge L2 community create itself in ways that are not in synchronicity with each other, you create siloed capital and closed loop capital systems, which doesn't promote the overall base system. And you don't see many of those dynamics really persist in the Solana ecosystem as heavily, primarily as a function of culture. I think that based on everything that we've gone through in the Solana ecosystem from 2022 onwards, is really built a tight-knit community to build applications and support for the community in a much broader sense with a much more objective goal in mind. And, all of those pieces combined is something that makes myself very bullish on Solana as well as the teams here.
Yeah, we've been on aggregate, the kind of people that we have in our ecosystem, in our teams, we've been looking at everything since Bitcoin, Ethereum, and then everything that came after it. And you've been in that journey. You start to develop your sense of the large number of factors you need to keep a handle on in order to assess whether an L1 is going to really get somewhere and do something and what it's known for. And I think one area of expertise we haven't talked about is Apex E3, which is one of our portfolio companies. Usman and he is the CEO there, and he and I were involved in launching very early Solana coins way back in March of 2021, and that far back, and we got really comfortable with that ecosystem very early on. So it's not new to us at all. I think what we've noticed over the last few months, and again, always thinking about it with that lens of how do we get the net new billions of institutional money in the door. That's what we want. Solana feels like it's reached a point of maturity and scale, and whether it be from a technical perspective, from a liquidity perspective, from a cultural perspective, that feels like it's got the ability to land with an institutional client base for the right reasons. And I think that is a big part of the reason that we went for it. We will be non-denominational, though. I think over time we will operate across the entire ecosystem. We will choose where to go as we see the opportunities arise. But there's something to be said for this Solana story, and look, there's a reason why we've seen the price action go, where it's been recently. That's because I think that call's starting to be kind of assessed and viewed the same way by a lot of others. So we're very excited about supporting the growth of Solana and institutionalizing that to the extent that it makes sense to do so. That's why we're here.
Absolutely. And finally, I'd just like to wrap and ask kind of the roadmap. I know, Ben, you alluded to it a little bit, but remind people what they can look forward to. And then finally, where can they find you both online?
Absolutely. So here's the plug. If you go to solsticelabs.io, at the moment you can sign up for the newsletter and keep updated for our initial launches. What is important and what I will announce now is that there will be an associated TGE to the protocol itself in a very short time frame after the launch of the protocol. And we expect to start those incentive programs and start to expect those engagements with the community in the new year, starting in January and February. So head over to solsticelabs.io, get registered up, and stay updated with the community. We're excited to get involved.
Absolutely. And where can I find you both online? I don't know if you're Twitter or LinkedIn people, but shout out your username there.
Yeah, I'll shout out mine is Ben_Solstice, and you can also check out Solstice Labs on Twitter as well.
Yeah,
Tim, I'll let you plug in.
At Tim J Grant usually finds me on Telegram or Twitter or anything like that. That's how you get me.
Perfect.
Fantastic.
All right. Well, everyone go engage with Solstice, go engage with Ben and Tim, and let's continue building the future of Web3.